All right, everybody, good morning. I hope everybody's well. We start our 12th week of our spring semester. Not too many weeks left. We're almost in the month of May, and that means it's finish up time. We're in our 7th week of this ungodly quarantine, and we're in the 6th week of our online study. So, welcome all. I hope everybody is well and got through the weekend and didn't kill any of your brothers and sisters and were able to get through it okay. Today, our discussion is on stocks. And I think of anything in personal finance that is, excuse my expression, ladies, is considered sexy, it's stocks. Because in stocks, you can make the most money. That's where the greatest money is made available. Also, you can lose it all very quickly. Just ask anybody who was in a ETF fund about 6 weeks ago in their 401k or their IRA, how that feels this morning, where roughly we've lost about 16 to 20% depending on where you're investing. Stocks are risky, but stocks is where you make your money. Since World War II, the average gain in the stock market has been roughly about, over the course of that time, roughly around 10 to 11%. In other words, if you invested overall at the end of World War II, you've made 10% a year since World War II. That's 50 years. You do the math. Stocks make money. But also at the same time, stocks have risk. The thing about making money in the stock market is where you make money is you have to be patient in the long term. You have to be patient in the long term. That's where you make your money. And every place else in the market or in investing, it depends on how long you want to make the money over a period of time. If you want to be liquid, you put it in a savings account. If you want long-term gain, you put it in a stock. If you want guaranteed fixed income, you put it in a bond. If you want to be risk and become the next Warren Buffett, you buy options. You buy futures. But at the same time, you have to understand, and we've talked a lot about this in our class, you have to understand the nature of the risk. But stock is where you make your money, and naturally you want to keep it long term. That's why a lot of investors now are buying instead of selling. Why are they buying? Because the market has gone down. It's cheap. Now they're investing in stocks for the long term, for the next 10 to 15, 20 years, because it's going to take companies many quarters to get through this mess. A lot of companies this week are going to be announcing their earnings report. Adidas this morning said their revenue was down roughly 40% from the prior quarter. 70% of their stores are not open. You're going to see that all week as companies announce their earnings. It's going to take time for companies to come back. But if you're patient over that time, you'll make your money. It's just if you're in the stock market today and you want to be out by the end of the year, you're not going to make much money. So that's the key thing about stock. Stock provides investors with an ownership interest in a corporation. It's basically considered growth. Most companies make money. So you buy stock as ownership of that company, you're going to make money just like the companies are. You also have the ability to buy preferred stock, which is a cross between stock and a bond. Preferred stock is where you have a dividend, guaranteed. It's income oriented. All right. You have to get income. Let's say you don't want to buy a bond and wait 5 years to get your money back as a principal. You buy a stock, a preferred stock, where you get guaranteed income, usually anywhere from 1 to 3% of the stock value, of the par value, and then you get income every quarter. Now, naturally, the stock is not going to grow much as common stock. Why? Because preferred stock, people buy it to own it, to get the income. They're not buying it to buy and sell. So preferred stock usually trades very to the original purchase price, but you get income. You don't have to wait for maturity to be paid like a bond. You get income every quarter, and you can cash out at any time. So those are the two main types of stock. But the behind the scenes of these stocks are also very important. With common stock, you get a voting interest in the company. You can say, you know what? I don't like you running my business. You're fired. You get a majority of your stockholders to agree with that. You can change the management of the company. Preferred stockholders do not get a voting share of the company. They cannot vote. Common stock, you get a voting share of the business. Also, common stock tends to be a little bit more liquid. There's usually a market for stock in the market. Sometimes preferred stock, it's tough to find somebody willing to buy your stock if you want to sell. The market is rather limited. We'll talk more about that on Wednesday when we look at an E-Trade account with stock and with common stock and preferred stock in it. So the bottom line with stock is you need to be patient. You need to do your research, and not only research about the company, but research about your own investment goals. Okay? Why do companies issue stock? Well, they use that capital to expand the business or to start a company. But usually most companies are pretty well started before they issue stock. Okay? It's called startup funds, hedge funds, private equity, Shark Tank. They're the capital that set up companies. But when companies want more, want to create new markets, want to grow, they need more capital. That's when they issue stock to get that greater capital. Okay. Also, companies like to use stock to I don't know, to invest in risky businesses. Use that capital to set aside to try to go into new companies, new areas. All right. Companies have what are called board of directors. Board of directors are voted or representing the shareholders. For example, just last week I got a proxy statement from Walt Disney. They had some new directors they wanted to put on the board. The shareholders have to approve those directors, whether they should represent them. And I had to place a vote on those people that I thought would be good directors of Disney. Shareholders have voting rights. Preferred shareholders do not. Management needs to listen to these board of directors because why? Board of directors hire the management of a company. CEO, CFO, president, chief legal counsel, even some vice presidents. The board has to sign off on their employment contract. So in other words, management needs to listen to the board. The board listens to the shareholders. Very important concept in stock. You can make money in stock 3 different ways. You can get dividends. The stock can go up in value. And you might get increase in value by stock splits, when companies split the stock. A stock split is when shares of stock owned by an existing shareholder are divided into a large number of shares. For example, a 2-for-1 stock split. At the end of a stock split, if it was 2-for-1, you now own double of the shares you owned before. But at the same time, the price of your ownership is exactly the same. Example, I bought a stock at $100 a share. I bought 10 shares of stock. All right. That's a total investment, a total investment of $100. I bought it at $10 a share. If the stock is split, I now own 20 shares of stock, but the stock is now worth $5 a share. All right, the value of the stock splits as well, but I own double the amount of shares. So if the stock price starts going up again, I now increase my value because I now own more shares of stock. Right? A lot of companies do that, split the stock. So those are the 3 primary ways you can make money on a stock: dividends, appreciation, and the splitting of the stock. When do you get a dividend? Well, some companies pay dividends every quarter. Some companies pay dividends every 6 months. Not very many companies pay every year. It's called a declaration date. That's the date the board of directors decides to issue a dividend. All right. The record date is the date of who owns stock in the company. And the X date is the second day before the record date. The stock begins to trade without a dividend. In other words, investors buy after the X dividend date. They do not get a dividend. One of the things you have to remember, if you start buying stock Always ask when the record date, when was the X dividend date. You know you will not get a dividend for that quarter because you're purchasing after the date the dividend was declared. And sometimes investors get confused about that. Geez, I bought this stock to get the dividend right away. Well, if you bought it too late after the board of directors decided to issue the dividend for this quarter, you have to wait another full quarter until you get a dividend. And you'd be surprised, a lot of investors buy stock not so much for the appreciation, but for the dividend. It's very important. Preferred stock. Okay, as we said before, the dividend is always paid every quarter. It's guaranteed. All right. If a company decides this quarter to not pay a dividend, those dividends accumulate. In other words, oh, I get a preferred stock. I get $2 a share dividend every quarter. The company has some financial trouble or they want to withhold dividends. The next quarter, they'll have to pay you $4. Because why? It accumulates. You'll still get your money. It's just you might not get it in that quarter. All right. And many times preferred stock can be converted to common stock. It also can be converted to a bond in many cases. All right. It's called a hybrid security. Non-voting, low percent chance of growth, but you know you're getting your cash money, dividend. That's the advantage of preferred stock. And also for companies on the company side, a preferred stock is the only way they can issue equity capital. Many companies are so new or have bad credit that the only way they can get capital is to guarantee a payment like a preferred stock to the investor. That might be the only way they can get stock issued in the market is to issue a preferred stock. Also, preferred stock is the choice for many utilities and regulated industries. Regulated industries like utilities, electricity, water, gas, those regulatory industries by the government. Here in the state of California, every year the state power companies have to go to the regulatory agency of California and get approval for rate increases. Part of that rate increase is to get enough profit so they can pay preferred dividends. But because it's regulated, certain electric utility companies and all electric utility companies and gas and water cannot make huge profits. Why? Because everybody needs water, electricity, and gas. So it's regulated. So because they're regulated, that's why one of their main reasons that they issue stock is preferred stock, because they can't promise lots of stock growth, but they can promise quarterly dividends. Many utility companies issue preferred stock to raise capital. There's different types of stock. If I go into E-Trade, or if I want to go to an investment broker or manager, one of the first questions they ask you after you say, hey, I want to invest in the stock market. Well, what type of stocks are you looking for? Are you looking for income stock that may not grow quickly, but guarantees or offers you a cash dividend higher than most companies? You'll be in it for the money, for the income. Utility companies, like I just said. Or you might want to be in a growth stock, a company that offers the promise of much higher profits in the future and has consistently record of relatively rapid growth in earnings in all economic conditions. What would be considered a growth stock today? You guys might laugh at this, but I would still consider Amazon a growth stock. It's still growing. Their performance has indicated higher profits in the future. They own their market. That would be considered a growth stock. So different types of classifications of stocks. There's speculative stock, a company that has potential in their earnings in the future but showing nothing today. What would that be? Solar power, windmills, maybe battery technology, biotechnology, biofirms, trying to cure cancer, trying to cure drugs, but are years and years away. Those would be speculative stocks. You're kind of taking a little risk, but the potential is huge growth over time. In 1984, Apple Computer was considered a speculative stock. It was considered speculative. Apple Computer, who, what, where? Oh yeah, there's a couple dudes in Palo Alto making computers out of their garage. I really? Well, I think I'll stay away from that one. But the chance of potential earnings, if you could see the future of technology at that time, it would be considered a speculative stock. Then you have what is called blue chip stocks. General Electric is a blue chip stock. It's well regarded, has a good reputation, dominates its industry, has been solid and a safe investment. Blue chip stocks maybe are not growth stocks because maybe they've reached the top of their business model. But at the same time, they have proven performance by their management and would consider be a safe investing. Blue chip stocks are the Dow Jones Industrial Index. Those are considered blue chip stocks. And then you have a value stock, a company with a stock that is selling for less than its true worth of assets. In other words, a value stock is considered cheap. Cheap. Company has a lot of rich and wealthy assets, but the market thinks, well, there's not much growth there. There's not much profit there, but it's considered a value. It's cheap. So as you can see by this listing, when you go and buy stocks and buy equity, there's different cycles or different pieces of the stock market that you can get into. Speculative, blue chip, value, growth, income. These are all areas of the stock market that you want to be able to look at. If you have a lot of money, let's say $100,000, and if you have $100,000, please let me know. I would love to become your friend. But at the same time, if you have $100,000, you might want to have a mix of speculative, growth, value, blue chip. Do a diversified portfolio of all these different types of stocks. Then as the market increases, some stocks will really outperform, but other stocks will be lagging behind. But then if the market changes, those laggers might take up more of your growth and the other ones slow down. It's a diversified portfolio. So that's what stocks are and how they are designated. You're investing in the future. You're not investing for next month. You're not investing for tomorrow. All right? You're investing in your future. Let's take a look at a video that I've posted and mentioned in my introductory video last night or yesterday. Let's take a look at a video that kind of summarizes the history of stock. Let's take a look at that.
In the 1600s, the Dutch East India Company employed hundreds of ships to trade gold, porcelain, spices, and silks around the globe. But running this massive operation wasn't cheap. In order to fund their expensive voyages, the company turned to private citizens, individuals who could invest money to support the trip in exchange for a share of the ship's profits. This practice allowed the company to afford even grander voyages, increasing profits for both themselves and their savvy investors. Selling these shares in coffee houses and shipping ports across the continent, the Dutch East India Company unknowingly invented the world's first stock market. Since then, companies have been collecting funds from willing investors to support all kinds of businesses. And today, the stock market has schools, careers, and even whole television channels dedicated to understanding it. But the modern stock market is significantly more complicated than its original incarnation. So how do companies and investors use the market today? Let's imagine a new coffee company that decides to launch on the market. First, the company will advertise itself to big investors. If they think the company is a good idea, they get the first crack at investing and then sponsor the company's initial public offering, or IPO. This launches the company onto the official public market, where any company or individual who believes the business could be profitable might buy a stock. Buying stocks makes those investors partial owners in the business. Their investment helps the company to grow, and as it becomes more successful, more buyers may see potential and start buying stocks. As demand for those stocks increases, so does their price, increasing the cost for prospective buyers and raising the value of the company's stocks people already own. For the company, this increased interest helps fund new initiatives and also boosts its overall market value by showing how many people are willing to invest in their idea. However, if for some reason a company starts to seem less profitable, the reverse can also happen. If investors think their stock value is going to decline, they'll sell their stocks with the hopes of making a profit before the company loses more value. As stocks are sold and demand for the stock goes down, the stock price falls, and with it, the company's market value. This can leave investors with big losses, unless the company starts to look profitable again. This seesaw of supply and demand is influenced by many factors. Companies are under the unavoidable influence of market forces, such as the fluctuating price of materials, changes in production technology, and the shifting costs of labor. Investors may be worried about changes in leadership, bad publicity, or larger factors like new laws and trade policies. And of course, plenty of investors are simply ready to sell valuable stocks and pursue personal interests. All these variables cause day-to-day noise in the market, which can make companies appear more or less successful. And in the stock market, appearing to lose value often leads to losing investors, and in turn, losing actual value. Human confidence in the market has the power to trigger everything from economic booms to financial crises. And this difficult-to-track variable is why most professionals promote reliable long-term investing over trying to make quick cash. However, experts are constantly building tools in efforts to increase their chances of success in this highly unpredictable system. But the stock market is not just for the rich and powerful. With the dawn of the internet, everyday investors can buy stocks in many of the exact same ways a large investor would. And as more people educate themselves about this complex system, they too can trade stocks, support the businesses they believe in, and pursue their financial goals. The first step is getting invested. Interested in pursuing your own financial goals? Download a free audio version of The Richest Man in Babylon on audible.com/TED-Ed. You'll not only get timeless advice on making and
Okay, I'm back. Okay, as you can see by that video, like a lot of the points we made already, investing in stock is a way of establishing a return over a longer period of time. And with technology today, the internet, you as an investor have tools that you can use to do it directly from your desk at home. From your, you can be on your car and somebody else is driving, and you can buy stock on your cell phone. The technology has made it a lot easier now to keep track and invest in stocks. And that's good, but it's also dangerous. It makes people think they're experts, okay? And that's a trouble. If you ever go to a restaurant or a bar and you start talking about the Dodgers, or you start talking about Trump, or you start talking about business, all right? Everybody's an expert, all right? Everybody knows exactly what's going on, but at the same time, they have no clue what's going on. Kind of reminds me of a faculty meeting. Everybody's an expert, but nobody knows really what's going on. You can quote me on that one too, all right? So that's dangerous. When you think, oh, geez, I know how to use E-Trade, or I know how to read stock pages in the Wall Street Journal, or, oh, geez, I took Assey's finance class, I'm an expert. Very dangerous. You have to be careful of that. Stocks change rapidly. Stocks change hourly. Stocks change psychologically. A big point of this video we just saw is the market is psychological. The market is people's interpretations of what they think is going on. And many times people have no clue what's going on. That is dangerous. So you have to be aware of that if you're getting into stocks. Also, you want to take a look. Oh, I have a chat here. Question. Let me guess who's this from. Are investors at a disadvantage with algorithm trading? Yes and no, Julio. Uh, Algorithm trading is set on certain parameters, certain guidelines, certain dimensions, okay? And many times those dimensions are tested over time through data analytics. The computers don't lie. Computers give you patterns. Computers give you changes in the market before you even know there's changes going on in the market. That can be a good thing. But as a small investors, you're kind of sucked in to that thinking. You're kind of like sheep going to get slaughtered. You're going to get slaughtered before you even know you're getting slaughtered. Or you're going to make money before you even know you're making money. And by the time you figure that out, it's probably too late. So yes, Julio, you are at a disadvantage, but at the same time, you're also protected by algorithm trading because you kind of have a heads up on the data on the analytics that you don't have in normal monitoring of a stock investment. So it's a risk and loss situation. It's a risk and gain situation. You don't really know because of the algorithms what's happening, but you have to trust them because it's data, it's computers, it's statistics. It's learning how things happen before they happen. So it's kind of a give and take area to investing, but it's also, again, as I said earlier, you have to recognize that in the aspect of investing. Going back to that technical side, you have cyclical stocks and you have what is called defensive stocks, okay? A lot of times you're in the market and you say, geez, the market's doing well, but my stock's not doing very well, all right? Well, that's because the company might be a cyclical company. Certain changes in the economic cycle or the business market might say, you know, everybody else is doing well, but I'm not. Good example of that is retail. Retail is very cyclical. If the economic business cycle is down, retail is down. If the economic business cycle is up, people are confident, people are working, people have money to spend, the retail stocks do well. What has been happening in the market in the last 2 months? It's been going down the tubes. J.C. Penney is about ready to file for bankruptcy. Neiman Marcus is filing for bankruptcy. Macy's is on the verge of bankruptcy. These are cyclical stocks because they change dramatically as the business cycle changes. Then you have counter-cyclical or defensive stocks. Stock from a company that performs well even when the environment is considered weak. A good example of that is Amazon. All right, that's a defensive stock. Why? Because they have created such a market that even when the economy is down, you know, Amazon stock is up 30% this year. 30% this year, where the market is down 16, 20%. Why is Amazon stock up 30%? Because they have such a control of the market, such a control of the supply chain, that they can go beyond the bad economy and keep making money. Another smaller example of that would be like a repossessing company, a company that repossesses bad loans. For example, let's say I have a car and I don't make my payments. That car can be repossessed. There's a lot of companies that do repossessions. When do those companies do well? When the economy is sucking, doing lousy. When people can't pay the bills, repossession companies are doing huge business because they're working for the banks to repossess and collect those assets. But over the last many years, repossession companies have been doing very poorly because the economy has been doing very well. Everybody's been working and paying off their debts. That's another example of a defensive stock. Stocks that do the exact opposite of what's going on in the economy. One of the things you have to remember is when you're looking at a company, what type of company is it? Is it growth, value, income? Is it cyclical? Is it defensive? Those are all called technical terms to determine the value or the risk of the investment. Now, one of the key things that everybody talks about is how do you evaluate your stock performance? You can get a prospectus. You can go to the SEC site and get the company's 10K report. You can get their annual report, which is basically a public relations gimmick. You can use business periodicals or the Wall Street Journal. You can use the internet like Yahoo Finance, which many of us are doing for our portfolios. There's a lot of sources of data out there. But trust me, not all that data is valuable. Sometimes it's spin city. Sometimes it's not really the truth. So you have to make sure when you're evaluating stock performance, and if you're asking somebody to represent you to evaluate stock performance, you got to make sure it's reliable. Do you trust that information? How do I know that I can trust information? Their track record. Do they have a high degree of consumer confidence? Is that source of information reliable? So that's why you have to make sure that you get information that can help you. One of the easiest forms of information is just go to the company's reporting and look at their corporate earnings, their earnings per share. How has the company performed quarter after quarter? Has there been a trend of growth or a trend of non-growth or being flat? As business students, you know what corporate earnings are. You know what sales are. You know what net income is. You know what earnings per share is. You've studied that. You've looked at that. Many of you even looked at it in your own individual companies when you're doing the practicum, how your performance has been over a period of weeks. With corporations, it's over a period of quarters. So you can judge that data. Over the next 2 weeks of this month, of last week of April and the first week of May, all American corporations will be announcing their corporate earnings, their earnings per share, their prospects for the future growth or non-growth. You take these into account, especially to provide you information about companies you've already invested in or thinking about investing. Other technical analysis are price earnings ratio, the relationship of the stock to the stock earnings per share. Is the market overvaluing or undervaluing a stock in relationship to the relationship of the stock price to the earnings per share? And also, what does the company say about the future? Projected earnings. This week and next week, when companies announce their earnings, they also will announce their projections for the next year. Where do they see their company going in the next year in relationship to the economy, to the market, to their own past performance? Every publicly traded corporation has to produce their earnings. If they're way off in those earnings, confidence in the numbers will dwindle for that company and they might have not much reputation in the market. So you got to make sure you provide information to your markets, to your investors, about what you're going to be doing in the past, but also what you're going to be doing in the future. Here's a typical page out of a stock report. We've seen it in Yahoo Finance. This is the Boeing company. Naturally, this is a few years ago, but it gives how the stock has traded, high, low, opening, where they expect to go, their 52-week range, the volume, how many people are buying and selling the stock. There's their price earnings ratio, their market cap, their earnings per share, their dividend yield, all gives basic information. We'll see this on Wednesday, but if you go into E-Trade or any Ameritrade or Charles Schwab Trade or Idiot Trade website and try to trade and buy stock, one of the first things you have to pay for in owning and being in that site is understanding the information of how your stock or projected stock buy is doing. It's called quotes. It's called daily information. You can download this, but if you download it, you got to pay for it. This is information that can be supplied to you off-site, like in Yahoo Finance, or in real time, and then you have to pay for it like in Ameritrade or E-Trade. What is the stock doing and its leading indicators? Price earnings, earnings per share, dividend yield, how it's been doing over the last day, the last week, the last year. All information helping you make sure your risks are covered in looking at this stock. Dividend yield is the relationship of the price of the stock to how much dividend they're paying. The price of the stock to the amount of dividend they're paying. Total return of a stock is the dividends plus the capital gains. Somebody says, I made 25% this last quarter or this last year in my stock. That means dividends that were paid out plus the stock price change over the last year. It's called total return. How are stocks bought and sold? And we'll talk a little bit more on this on Wednesday when we look at some real world stuff. But stocks are basically traded in two markets. For newly issued stock, it's called the primary market, IPOs. You are the first one buying the stock. Your money is going directly to the company. You're an original issue. Most of us are not in this league. Primary markets are insurance companies, pension funds, Warren Buffett, Bill Gates, major investment houses. Those are the people who buy primary market stock, an original issue. Then you have what is called the secondary market. That's the market that you and I trade in. If I call up my broker this morning or go on E-Trade this morning and want to buy 10 shares of IM HIP stock, that's the secondary market. It's already been issued. It's now trading amongst the market. That's called the secondary market. That's the market we trade in. I have a chat question. How do you short a stock? Well, now we're getting into a little bit of a technical area, but that's good because anybody is interested in television. This coming Sunday, I believe the 5th season of a show called Billions is going to be premiering on HBO, and Billions is about investing, stock, and mainly the primary markets. But also it talks about secondary market trading in addition to all the personalities on this show. But one of the big areas it talks about is called short selling. All right. What short selling is you anticipate the stock of the price of the stock to go down. All right. How do you do that? Well, you go to somebody, let's say Ashton wants to short sell General Electric. So he goes to his buddy Brandon, who owns 100 shares of General Electric stock. He says, Brandon, can you lend me your shares of stock? So Brandon, he doesn't sell them to him. Brandon just transfers ownership of those 100 shares to Ashton at a specific price. Then now Ashton has that stock as no liquidity, remember, but remember he has to pay Brandon back. And then what happens is now Ashton has that stock at a pre-designated price. And if the price of the stock goes down in the next considerable future, usually 30 to 60 days, in other words, Ashton now owns the contracts at one specific price, and now the stock has dropped in price, and that spread, which is called arbitrage between the new price of the stock after it has collapsed to the stock that Ashton has, that's profit that Ashton has made. I'll explain this in more detail on Wednesday when we have an example of a real world example of that. But selling short is betting that the stock will go down. That's what it is. Betting long means that you're betting that the stock price will go up. Those are big players on Wall Street. It's a lot of gambling because what happens is the stock doesn't go down, it goes up. You're going to be a loser. So we'll talk more about that later on Wednesday. But buying and selling stock are what is called options trading, futures trading, non-traditional trading, where there's huge risk, but also huge opportunities for profits. Another question. I don't see why, Julio, you just open up your mic and ask me these questions, but that's okay. Yes, options are considered derivatives, another form of investing in equity, but a non-traditional form of investing called derivatives. A lot of people may have made huge amounts of money in the hedge fund industry off buying short and long in the markets. Chapman University, we all know them. They cheat at baseball. They cheat in football. They cheat in volleyball, women's volleyball. They cheat. Let's call it as it is. Chapman University. But the reason why Chapman is Chapman and they have such nice facilities is they have a donor there named George Soros. Mr. Soros made a huge amount of money in 2008 and 9 going short on financial stocks. He made, can I say billions? Probably not. He made hundreds of millions of dollars in going short on financial stocks in 2008 and 9 when we had the tank in the real estate market. He made a friggin' fortune. And to not give all that friggin' fortune to the IRS, he gave hundreds of millions of dollars to Chapman University to fund everything at that institution. And that's how Chapman has grown so as far as facilities, athletic programs, learning how to cheat better in football, and that sort of thing. But that's Chapman. I should watch what I say here. Chapman, that's how Chapman got a lot of their money, from somebody who was very good in the short markets. Another question. Ashton, didn't Enron's CEO son go to Chapman? I have no idea about that one. Sorry, I'm not up to speed on the social aspects of their student body. I wouldn't be surprised. I know that a couple other influential people in the entertainment business have sent their kids to Chapman, but also a lot of them have sent their kids to Pitzer. But be that as it may, those institutions have made a lot of money off donors who have created huge gains in the stock market. And that's a little side story there. So we'll talk more about going short and long on Thursday. That's for us students being new graduates of a business program, that is getting into very dangerous territory if you don't know what you're doing. All right. It's sexy because you can make a lot of money in 2 hours, but it's also very dangerous, and you have to watch out for that. We'll talk more about that later. All right, where do you buy and sell stocks? Well, it's in the markets, and we've talked about that before. There's the New York Stock Exchange, there's the London Exchange, there's the Beijing Exchange, there's exchanges all over the world. And then there's the over-counter markets, NASDAQ, where you can buy and sell through a dealer network online. And those come now, and this slide is a little bit off. It's more like 5,500 companies now. Then it was 3,200 companies. That's where you buy and sell in the secondary markets. Or you can use a brokerage firm. All right. We have a few Laverne graduates or stock brokers in firms around the area. You can use them as ways of representing you in the market. Or you can use online trading. Discount brokers, Ameritrade, E-Trade, Charles Schwab. Those are trades or businesses where you deposit, let's say $2,500. You keep that $2,500 in. That allows you to open up an account with E-Trade, and then you can go on and buy and sell stock, but you always have to maintain that $2,500 balance, and then you put in additional funds to buy and sell your trades. But at the same time, it allows you to direct the sales, it allows you to control what you're doing, and you don't have to rely on a broker. Individual trading like this is fine, but if you're dealing with more money, it's getting into very dangerous. You make one mistake here and it could cost you dollars into the future many times over. So that's why you have to make sure you know what you're doing. Usually I use my E-Trade accounts for, let's say I go to Vegas and I win $500, or let's say I get a tax refund of $2,000. I use that money in E-Trade. But my 401k, my retirement money, I put in the charge of managers and brokers. I don't want to screw that up. But if I want to have a little fun in the market, I'll use that play money. And if I lose it, I lose it. Fortunately, most times I don't lose it, but still I've lost. And that's the kind of money you should do on this. Now, if you feel you're sophisticated enough to handle this, good luck. Skip over that. Okay, you can do different types of orders. A market order is to request to buy or sell. You can put a limit on that order by saying, okay, buy this stock when it hits $10, sell this stock when it hits $20. You can do a stop loss. If the stock starts losing, you can tell your broker or set in a control that says, okay, if I lose 5%, sell. If I lose $5, sell. It's called a stop loss order. All right. Brokerage fees range from $7 to $35 a trade. This is a little bit older. Now it's more like $5 to $40 a trade. It depends on the number of stocks, depends on whether you have a relationship with them. That's why I always say, where you bank, try to do your stock selling. Wells Fargo, Bank of America, can't do it at credit unions. But if you have an established account there, they know you. You've had your money there for a while. They'll probably give you reduced rates if you use their brokers to buy and sell. We'll talk more about this on Wednesday, but what should be my strategy? How long do I want to put money out? How short should I put money out? What is my investment strategy? Okay, we'll talk a little bit about this on Wednesday, but for most of us here, most of our investment strategy is put it out for long term. Put it out for years. Maybe the goal is a house in 10 years. Maybe the goal is to retire in 40 years. More investing is more long term. The shorter term investments are, well, I want to buy a car next year. The shorter term investments are, I just want to have a slush fund in case I get into financial trouble, I have a little backup. All right, those are short-term strategies, short-term investments. The nature of the investment is going to be a little different, a little bit more liquid, maybe in a mutual fund, an ETF if you want to get into stocks, maybe into some type of CD, savings account. But the longer-term strategies are investing in diversified portfolios. What is your strategy? What do you want to do? Now for that, short-term strategy is for aggressive investors are buying on margin, borrowing money from a broker, setting that margin and investing short, investing long. We'll talk more about this on Wednesday. But that leads us into another topic that's very important to us as students is, geez, I'm graduating from Laverne this year, or I'm graduating next year from Laverne, and do I have a job? Well, okay, yeah, I think I got a job. Okay, so you have a job, so you have income, you have revenue stream. All right, what am I going to do with that revenue stream? Well, I'm keeping track of a spending diary. I know where my money goes now. If I have extra money, where do I want to invest it? Do I want to invest it short term? Do I want to invest it long term? If I want to invest it long term, I sign up for a 401k at my employer. I don't touch that money. I got a certain amount taken out of every pay, and that's going to long term. And then if I have money left over out of my pay, I invest in short term. I open up an E-Trade account. I maybe buy a mutual fund, an ETF. I invest in a bond. I keep it short because I have control over that and I can cash that out when I want. It's difficult to cash out a 401k without tax implications. So these are all areas that you have to think about and which we'll look at on Wednesday of where I want to put my money and for how long and how dangerous or how cool do I think I am as an investor. I've had a lot of friends think they know the market, end up losing $100,000. I had a lot of friends who think they're boring because they put 5% of their pay every week into the 401k, but now they can retire early because they've had a regimented, disciplined investment strategy since day one. So these are things we have to think about in regards to stock and investing in that area, the risk associated. All right, Jacob, one last question before I let you guys go. What's the name of your dog there on the couch? What's the dog's name? Jake, turn on your mic. Tell me the dog's name.
His name is Walter.
His name is Walter. Is he your dog or is he the family dog?
Family dog.
And how old is Walter? He looks a little rough around the edges.
I think he's like 2.
You
We got
think
him
he's
off the
2?
street.
You got him off the street?
Yeah, we got him off the streets.
Kind of like how you
Yeah.
get your girlfriends, like right? Kind of like that. That's a
Pretty
joke.
much, yeah. Whole avenue.
That's a joke.
Whole
That's
avenue.
Carly's even snickering on that one. That's a joke. Sorry, Jacob. That's inappropriate for a Monday morning.
It's okay.
So Walter, we'll
All good.
give Walter. Are you going to walk Walter later on today? You got to take him out for a walk.
I might play with them in the backyard.
Okay, make sure you play with him and you shave afterwards. You need a shave. You know that.
Nah.
All
Not
right.
until I have to go outside.
Today is Pick on Jacob Day. All right, everybody. So that's the beginning of our discussion on stocks. On Wednesday, we're going to look at a couple of problems out of page 414 and 415. We're going to take, well, let me bring this up here before I do this. We're going to take a look at a few problems we're going to take, and we're going to review examination number 2. I see most of you have now posted your work for examination 2. I'll do those grades and have them posted by our class on Wednesday, and we'll take a look at that briefly, but I have a feeling you guys probably did pretty well on this. And then we'll take a look at the real world of e-trading and of Ameritrade, what it looks like on a screen to invest in stocks. If any of you have never seen that, that's kind of an interesting experience to do that. We'll look at that on Wednesday and talk about investment strategies. So thanks everybody. Have a good week. You know, it's almost over. We're doing pretty well. And I appreciate you all coming on this morning. So we'll see you on Wednesday. Adios.
Thank you.
Thanks, guys. Thanks, Jake.
Thank you, Cassie.
Yes, sir.
Thank you, Professor.
Thanks, Chris. Thanks, Palm. Hope everything's well. Take care, Palm.
A little late today.
Caitlin, it sounds like you're getting some more academic trading. I saw that on LinkedIn. Very nice.
Wait, what?
I saw something on LinkedIn about you.
Oh, yes. That was for one of my classes, actually, Business 494.
There you go. Very nice.
Bye, Mr. Hassey.
See you, Caitlin.
Just to let you know, Professor, I came in a little late today. I think about 15 minutes.
I saw that, Chris. No, thank you for letting me know. I appreciate it.
No problem. Take care.
Okay, you too.